because it's not just about planning. Planning is one thing, but you've got a whole, you know, where do you put your money ultimately? You know, you have, you know, somebody who can manage it and say, well, you know, you should probably have some element of annuities here. You should probably be in, you know, maybe some small cap and all that stuff.
How much money do you need in a safe environment, bucket number one style investment? How much money can you have in a pure growth environment, which would be an all equity real estate type position? But where do we put, how do we determine what that allocation is going to be? And how do we add to and subtract from the portfolio depending upon where we are in our investment cycle? There are ways for long-term growth managers, especially people that oversee the allocation, to try to reduce the volatility without, you know, so there's a couple of measurements that I like to look at, and it has to do with when your benchmark, who you're trying to beat, is going up. Is your portfolio going up? And if so, how much? At what percentage of the upside are you realizing in your allocation?
Yes.
On the other side, when the market's going down, how much of the downside? I don't want, you know, if I can find a way to get 100% of the upside with something less on the downside, that's great. Not always easy to do. But if I could get 70, 80% of the upside, so in a year like 2016 when the S&P by itself was up, what, 17% I think it was, if my growth portfolio was up 10 or 12, and then when the S&P is down, you know, maybe 10%, and I'm only down 2 or 3, that may be an acceptable issue for you. I think it makes a lot of sense. You know, people that are actually will tell you what's going on with market index, they say, this can't be money that you're going to spend in the next couple of years. So you have to have an overall strategy of money management before you get into the different types of allocations. You don't have one allocation. You have different allocations for different time sets. When you have money that you need to withdraw in the next 5 or 10 years, that may be one allocation. And it has nowhere near the volatility or the potential return on the other side that the money you don't need to spend for 15, 20 years has. And you don't mix and match. You don't take your income arbitrarily from the whole portfolio and then rebalance. And unfortunately, that's there's a lot of companies out there who do money management. And they disguise money management as financial planning, saying, well, here's this 2-page questionnaire to do. And they're looking at ways to try to make you believe that they're managing the volatility of your portfolio. But they're breaking the most common sense rule there is. Don't sell something when it's down.
Yes, and you know, buckets, the strategy addresses that. So hold that.